So we know that there are a lot of dividend stocks out there right now that you can get for really low prices. In fact, just looking at my own monthly dividend stock spreadsheet, there are over 150 dividend stocks that are trading within 5% of their 52-week low. However, there's one dividend stock that has been really beaten up lately and currently yielding over 15% on a 60% discount based on its historical yield. Today we're talking specifically about Medical Properties Trust, ticker symbol MPW. Is this an excellent opportunity to pick up a quality dividend stock, or is this dividend stock going to experience a dividend cut? Here are 7 things you must consider before investing in the dividend stock MPW. All right, guys, we're jumping right in here. The first thing you need to consider is that the dividend yield is so high right now because of its low price. The amount of the dividend for MPW has not shot up recently. It hasn't had a major dividend increase. The price has dropped significantly. As you can see from the price chart, the price right now for MPW at $7.43 per share is the lowest it's been since prior to 2013. And most recently was at a high of over $22 per share just at the end of 2022. Now, most investors would say, well, that might be a dividend trap then with such a significant drop in the share price. We'll take a deeper look at that in just a second. Second thing you need to consider here is the dividend streak. Specifically, Medical Properties Trust is a dividend contender. They have been raising their dividend every single year consecutively for 10 consecutive years. And we shouldn't discount that 10-year streak. That is a lot of years of consecutively raising dividends. They continue to raise them through the COVID crisis. Third thing you need to consider here, Medical Properties Trust, MPW, is a real estate investment trust, or a REIT. What it means is they own real estate, but specifically from a tax classification standpoint, they are mandated that they pay out at least 90% of their taxable income every single year to investors. The other thing you need to consider here is because it's a real estate investment trust, it is not considered a qualified dividend when you receive income from this investment. Income from a REIT is considered ordinary income, which means it is best owned in a tax-advantaged account such as an IRA, Roth IRA, 401k, etc. Fourth thing you need to consider here is not only does MPW have a streak of raising their dividend every year, but they also have a dividend growth rate that exceeds the long-term inflation rate. For MPW, the 1, 3, 5, and 10-year dividend growth rate is 3.6, 4.4, 3.9 and 3.8%. And the long-term inflation rate is right around 2 to 3%. Now, we all know that we're experiencing significantly high inflation right now. Long-term, it's much lower than that. This is good news for dividend investors because it means that inflation is not eating into your income every year and the increases are exceeding inflation. Fifth thing you need to think about here is with MPW, you do have the ability to sell weekly options on this stock, and their option chain has a pretty good amount of option liquidity. A lot of dividend stocks out there only have the ability to sell monthly options, and the amount of volume and liquidity that's actually traded is really low, which means it's not really a great viable option for generating additional cash flow. But with MPW, you do have the ability to sell covered calls on a weekly basis if you want to. In fact, you have the ability with covered calls, depending on the strike price you use and the delta and the frequency in which you sell options, you have the ability to potentially double your investment in Medical Properties Trust through covered calls. Sixth thing you need to consider here, and this is where we get into the meat of the issues, is MPW, or Medical Properties Trust, has some very concentrated tenant issues. Medical Properties Trust is a real estate investment trust, and they own hospitals, and they lease them out to healthcare groups. There are some really great SeekingAlpha articles that I will link to in the description below that really speak to some of the core issues. But as this article mentions here, there are 3 specific tenants that are causing more problems than the others: Pipeline, Springstone, and Prospect. As this article mentions, Pipeline went bankrupt, but due to their underwriting standards of MPW, they owned its good assets, and Pipeline assumed its lease in bankruptcy, and they're continuing to pay full rent. That's a good sign. The Springstone assets were sold to LifePoint, which are now leasing out the property. The Prospect tenant has properties in both California, Connecticut, and Pennsylvania, and essentially the issues are around the Pennsylvania facility. There's the breakdown of the different tenants based on the Q4 2022 report for their portfolio. You'll notice here, when it comes to rent coverage, pretty much everything is pretty solid except for Prospect, which has rent coverage of -0.5, so operating at a loss, but the others are really strong, with the exception of right here, Springstone at 1.3x. Everything else is operating at least 2x. Seventh thing to consider here, and maybe the most important, is, in my personal opinion, the dividend for MPW is safe for now. When we talk about dividend safety, we ordinarily talk about the payout ratio, but based on free cash flow. But when we talk about real estate investment trusts, it's a little bit different. We can look at free cash flow, but a better way to look at REITs specifically would be to look at adjusted funds from operations, or AFFO. Most recently, in February 2023, they declared a regular quarterly dividend of 29 cents per share, which, based on their fourth quarter payout of adjusted funds, AFFO, that's 85%. This means that despite the really tough times that MPW is dealing with right now with these tenant issues, they still have more than enough cash flow to cover the dividend. For me personally, full disclosure here, I do own 400 shares of Medical Properties Trust. Now for 200 of those shares, I'm actually underwater by quite a bit. I think my cost basis is around $12 per share and we're done at $7.45. Over the other 200 shares I picked up at really low prices because I feel like at the end of the day, they're dealing with some tough issues, for sure. But at the same time, I do feel like the market is over penalizing them for their issues and that what we're experiencing right now is probably likely the worst of it. Therefore, for me personally, I have no problem owning 400 shares of MPW. My total investment is maybe $2,000 or $3,000, which represents less than 2% of my portfolio. So if the worst were to happen and MPW were to continue to decline and cut their dividend, then for me, the worst case scenario is only $3,000 in a very small portion of the portfolio. However, if it rebounds well, I've got capital gains, got an ultra high dividend payout, and I have the ability to sell covered calls, which I currently do on my shares. Hopefully you found some value out of this video, guys, talking about Medical Properties Trust. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to all comments left on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.